Hello everyone, and welcome to another informational video for Closed-End Fund Mastery's Super Screener and Interactive Report. For those of you not familiar with Closed-End Fund Mastery focuses on three primary goals: distribution sustainability, long-term appreciation potential, and being well positioned for future distribution increases and special distributions. To get better acquainted with this powerful tool, I have left some useful links in the description below. And on to the video.
Hello everyone, and welcome to another Closed-End Fund Mastery installment. Today we're going to do a follow-up to the Closed-End Fund Mastery video I posted lately regarding the comparison of the funds GOF versus PDI. In my video comparing GOF and PDI, near the end I provided a list of behaviors to be aware of that might indicate if either fund's distribution could be threatened. But before we go into that, if you haven't subscribed already, you might want to consider subscribing to my YouTube channel. Coming soon, I will be posting a video doing a deep dive on the funds CLM and CRF. If you have any interest in closed-end funds, I'm sure you're well aware of these two particular super high yielding closed-end funds. In the video, we will be exploring the seemingly awful long-term price performance of their shares. We will be examining the history of constant rights offerings. And for those of you that do own CLM and CRF, I will also be addressing the taunts you may have experienced in chat rooms and postage boards by people asking you to just go ahead and send them your money, and they'll be more than happy to send it back to you for a small percentage. I do intend for that to be my next video. So if that sounds like something you'd be interested in, go ahead and click subscribe and notifications for whenever I put out a new video. Now let's get on with this video. GOF versus PDI follow-up. Not much time has passed since I posted the video comparing PDI and GOF, but since then both funds have reported, and I thought we would take a look at the two funds post-report to see if we can determine if either distribution is weaker or safer since I posted the video. So going over the list of possible warning signs, we'll briefly discuss each one to see if we should be more or less confident in these two funds' ability to maintain their distributions. First, we'll look at owner's equity. First, we're going to take a look at the fund GOF. Click on owner's equity. What you are looking at here in November of 2021 is an influx of capital GOF received as a result of absorbing other funds within its fund family. The situation is basically the same with the fund PDI when they reorganized in December of 2021. As a result of incorporating sister funds into their flagship high-yield funds, they did receive a lot more capital, but they also received a lot more shareholders. And as a consequence, that significantly increased the amount of money they had to pay out to shareholders every month. And as you can see here, the negative impact of that was instantaneous, as both PDI and GOF started to show a significant deficit in their earnings. This caught my attention, and this is what prompted me to make the last video in the first place. I know a lot of my paid subscribers are heavily invested in these two funds because of their high yields. Now at Closed-End Fund Mastery, we rank and score all of the highest yielding closed-end funds, but Closed-End Fund Mastery's pride and joy comes from bringing the highest quality, highest yielding funds to the forefront. However, it's not to say that you can't make money off of all of these other funds. Like the saying goes, one man's junk is another man's treasure. Anyway, despite the huge earnings deficit that currently appears to still be growing because of their reorganization and subsequent use of their at-the-market facility, which we'll go over in more detail later, both funds continue to build on their capital reserves. And as I mentioned in my last video, for this reason, it is highly unlikely that there will be any short-term cuts in either fund's distributions. Very quickly taking a look at the owner's equity comparison between GOF and PDI side by side for this period over the last period, which was discussed in the last video. On the left we have GOF. You can see there was an increase in capital, and that increase was $151,155,512. The deficit continued to grow after all distributions were paid to a negative $64,106,611. The capital raised was more than 2 to 1 to the additional negative distributable earnings. So GOF for the period was net cash flow positive for the period. For PDI, they increased their capital by $365,968,000. while increasing their deficit by $37,605,000. The amount of capital raised was almost 10 times the amount of the increase in the deficit. So PDI for the period is net cash flow positive. Now you might be thinking, sure, these funds are raising capital enough to pay the distributions, but they're losing money every period. That can't be good. To that I would have to say, not really. If you spend any amount of time in the closed-end fund space, you're going to learn real quick that a lot of these funds would not be able to pay their high yields had they not raised cash on a regular basis from outside of their earnings. That's just the way it is, and it's not necessarily a bad thing. And in many cases it can actually be a good thing, but that's too in-depth for the video that we're doing now. The one thing to take away from these two charts that I just showed you now is that they are net cash flow positive after paying their distributions, and that's a good thing for the stability of the distribution. Now, out of curiosity, I wanted to know if either fund ever found themselves in this position of huge earnings deficits before. Because I'll be honest, when I first saw these deficits, my first thought was there's no coming back from this. So I started to think back, when was the last major market crisis that might show me the scenario that I'm interested in. Obviously there's 2020, but that was too close to the bear market and we just got out of in 2022, so I needed to go back further. So my mind naturally wandered to the housing market crisis in 2009. Unfortunately, PDI wasn't around in 2009. And as an aside, because PDI uses so much leverage, I think PDI would be taking the path of PHK when they started making distribution cuts. To understand what I'm talking about there, you would have to go and watch the last video I put up. I'll include that link in the description below. Fortunately, the fund GOF was around in 2009. So I went to the Securities and Exchange website and I pulled the 2009 annual report and learned that at the time GOF had a negative accumulated earnings of over almost $53 million, which at the time was nearly 47% of the fund's net asset value. Fast forward to 2024, the fund GOF is much bigger by a factor of more than 10, and their accumulated earnings deficit is almost 6 times larger today than it was in 2009. But that negative deficit only represents around 19% of the total net asset value. So even though the dollar numbers are bigger, the percentages are much smaller. So if GOF can dig themselves out of a negative 47% deficit to net asset value, I see no reason why they can't dig themselves out of a nearly 19% deficit to net asset value. The next possible warning sign to look out for is either fund fails to recover to a previous high after a major correction or crash. We're not going to spend a lot of time on this particular bullet point because the answer to this is inconclusive at the time. However, in the last video I illustrated using the fund PHK that a fund paying a high yield while simultaneously carrying a large amount of leverage will often find itself in a scenario that when a market crashes or corrects and the fund then has no change to its distribution or its leverage policy, it will often find itself unable to return to its previous high before the next correction, creating a never-ending cycle of lower highs. The line in black represents PDI, and you can see in the first correction it did manage to exceed the previous high, and in the following correction it at least made it back to the previous high. But then in the crash of 2020 it failed to get back to its previous high, and now after the bear market of 2022 it again has not reached its previous high. A similar situation for GOF. Shortly after the fund started in 2007 and went right into the crash of 2009, but it did dig itself out and exceed its previous high. And then after its first major correction, it did somewhat manage to get back to the level before the correction began. And then after 2020, not quite, but almost to the previous high. And as we stand now, has yet to get back to its previous high. And since we're currently not in a major correction or crash, only time will tell if GOF can make it back to its previous high and whether PDI can also make it back to its previous high. So until then, there's no point in losing sleep over this. Next up on our checklist of things to be mindful of is the fund's premiums performance. Because the fund's GOF and PDI rely heavily on a facility called the ATM, or at the market, to raise funds, which if they did not utilize this ATM facility, their distributions would have been cut a long time ago. I went into what an ATM facility is in the last video, and just to give you a crash course on the ATM facility, ATM facilities allow the funds through a third party to facilitate the sale of additional shares on the open market. And to get the maximum bang for their buck using their at-the-market facility, it's important that their shares trade at a premium. The higher the fund's premium, the higher the share price, the more cash that goes into the fund. And when I came out with the last video, which was around October 15th of 2023, I had pointed out that GOF had lost 46% of their premium, and that PDI had lost a whopping 85% of their premium. And I also pointed out that if the premiums continued to fall, it could jeopardize the use of their ATM facilities, which thereby would also jeopardize their distributions. Now, when I was gathering my research materials for this current video, I did a last-minute check on the market prices of these funds. I was shocked to discover that after I put the video out, that share prices, that market prices, continued to decrease, which would have a direct impact on the fund's premiums. My video came out here, and within a week after posting that video, the premiums for GOF and PDI completely disappeared. They've since rebounded far above the point at which I made the video, which is a good thing. But had you watched my video when it came out and have me tell you that this is an area of concern, and then the week after it completely disappears, probably would have had you a little more than nervous. But like I said, fortunately they've both rebounded since. The percentage increase for PDI's premium is much greater than the increase in the premium for GOF. However, GOF currently has a higher premium at 22.55% compared to PDI's at 13.24%. So all is currently well on the premium front. Now, before we move on to the next point, I want to point out an observation that happened upon not too long ago. Regarding a fund's ATM facility, I've always been amazed at how quickly and easily these funds seem to be able to raise millions and millions of dollars at the drop of a hat. Now, I know these people are connected and they have the means to access virtually an unlimited resource of money or funding, but it always surprised me at how fast they've always been able to raise it. And a question that keeps recurring in my mind is, are these funds buying and selling their own shares among other funds within the same family, and to what extent? I went over to CEF Connect to pull up the top 10 holdings for PDI, and I noticed a bunch of obscure holdings that aren't very descriptive. But then I log into my brokerage account at Schwab and find that the largest position size in PDI is other PIMCO funds. Now, I'm not suggesting anything nefarious. The point I'm trying to make about this is that it appears it would be another lever to utilize to help bolster the fund's distribution. But consider this: depending on the amount of buying and selling among their own funds, do you not think that might help with boosting the fund's premiums? Just floating that out there. Next on our checklist is to explore whether fund inflows failed to cover fund outflows. In the last video, we compared GOF and PDI side by side. These are fund flows charts provided by Closed End Fund Mastery. And as you can see in the GOF chart on the left, fund inflows consisted of net investment income, realized gains, reinvestment, and share transactions. The share transactions could be anything from shelf offerings, rights offerings, or use of an ATM facility. And in this case, it was the use of an ATM facility. The transparent blue bar in the center are the outflows for the distributions. You can see the bottom half, dark blue, is distribution. Top half was return of capital. And you can see that if not for the ATM facility, the total distributions for this period would not have been covered. And the same goes for PDI. PDI didn't log any return of capital. They experienced a realized loss, but they managed to cover the distribution fully because of the ATM facility. Now in this video, we're not going to compare GOF and PDI side by side, but GOF period over period. You can see the annual and the semi-annual, and PDI period over period. Over here in the chart on the left, this covers an entire fund flow activity for an entire fiscal year. The fiscal year ends in May. It is not a calendar year, so that can be a bit confusing. And then over here under the semi-annual fund flow transactions, we have year-to-date activity up to November 30th, 2023. Notice they didn't include any return of capital so far this year, but that's likely going to change when they bring out their next annual report. And again, you can see that year-to-date GOF has comfortably surpassed their distribution amounts, but solely because of the use of their ATM facility. And again, the same goes for PDI. If not for the ATM facility, distributions would not have been covered year to date. But in both cases, as it pertains to distribution sustainability, you can see that as for the moment, distributions are covered. Next up, we have reduction and distribution amounts. And to this, we can safely say that there have been no distribution reductions or increases since I put out my last video in October. So that gets a check. And finally, we're left with the state of distribution to date based on net asset value. I don't know if people can fully appreciate net asset value. Net asset value is such a powerful number. Net asset value is the net sum of a fund's entire life's transactions at a point in time. It is the sum of all assets minus all liabilities. It is the net sum of all income less all expenses. It is the net sum of all paid-in capital less all returned capital and distributions. Notice I lumped distributions into capital. That's because distributions are not considered an expense but a finance activity. Dividing a fund's net asset value by the number of outstanding shares makes the net asset value even more powerful because now we have a unit of measure which can be compared to something else, specifically the net asset value of the fund at a different point in time. Doing so then allows us to know if since that other point in time with all assets minus liabilities and all income minus you get the idea. Lets us know if the fund is better off today than it was at that point in time. What makes the net asset value more powerful still is that funds publish the daily net asset value share every following trading day. This gives us a true financial picture of a fund's health every single day. Unlike stocks with their book value equivalent, they only publish once every 3 months. What makes the daily net asset value once again more powerful is when you know the best point in time to compare the net asset value share price to. For example, we're going to head over to CEF Connect and pull up a net asset value performance chart for PDI. Now this isn't CEF Connect specific. Most places you go you'll find the same thing. Notice you have a 3-month, 6-month, 1-year, 3-year, 5-year, and 10-year time frames. We're going to focus primarily on the 3-month and the 6-month time frames. There's a few things wrong with this chart. First of all, 3 months from what date? I took a screen capture of this chart on my laptop, and as you can see, the date on the chart is April 30th, 2024. But if you look to the right, you'll notice a little snippet of my clock and calendar also in the chart, and it's dated May 18th, 2024. So the first problem is the chart is outdated because it only updates once a month. If you're watching this video mid to late month, head on over and check it for yourself. The second thing wrong is that all returns assume distributions or reinvested, so it doesn't reflect true net asset value performance. That's why you'll notice if you scroll down the list of funds on the Super Screener in Closed-End Fund Mastery, you'll notice a lot of 3 and 5 year returns which are positive because these are distributions reinvested. But if you look at the 5-year NAV price changes next to those returns, a lot of them are in the negative. Some as high as negative 30, 50%. And lastly, since we know that this chart can be up to as long as a month behind, then the 3-month and the 6-month returns can be actually anywhere from 3 to 4 months to 6 or 7 months old. Why is this significant? Take a look at the 3-month NAV returns of 2.49%. What if the week before the 3-month period the fund was down 3 or 4%? And let's not forget, this is assuming that you're reinvesting your distributions. The exact point in time when you should be comparing today's net asset value price to the previous net asset value price is when the fund last reported. The net asset value price last reported is the net of all transactions compared to the daily net asset value price, which is also the net of all transactions. Anything over 0% means that since the fund reported, after all transactions including distributions paid, the fund is in better position than when the fund last reported. But most importantly, or just as importantly, it means that distributions to date have been covered. An awesome addition that I made to Closed-End Fund Mastery is the net asset value heat map. You could go to all 326 closed-end funds websites or pull up the individual reports on the Securities and Exchange Commission to find this information, or you can have it all right there in front of you in one screenshot. But as it pertains to GOF and PDI, let's head over to the fund comparison tool. We'll enter in our selections and see how they're doing. Under this column, ending NAV, this is the net asset value share price that was included in the fund's last report. If we head all the way over here to the current net asset value, we have the most recent current NAV price, which is in this report as of May 18th, today, 2024. And if you look in the column next to it, you can see that GOF, the NAV percentage change since it last reported, is negative 0.7%, and PDI is negative 1.2%. This means that since the fund last reported, all assets minus liabilities, all income minus expenses, all paid in capital minus return of capital, if applicable, and distributions paid, these funds are currently coming up short on their distribution obligations for the period. These numbers also reflect the use of their ATM facility. So it looks like these funds have a little catching up to do. But even if they fail to make up the difference by the next reporting period, it's still not time to panic because the shortfall could be reflective of unrealized losses in the portfolios. But that's why you need to keep an eye on these things. I want to thank you for taking the time to watch this video. If you haven't subscribed yet, please subscribe. Again, I'll be coming out with the CLM and CRF video as soon as I can. If you would like to receive a free closed-end fund mastery report, all the information is provided in the description below. Take care.